Rahim. Assalamu alaikum. Good afternoon, good evening, everyone. It's my pleasure to welcome you all to this webinar today, where we plan to discuss the global impact of COVID-19, the economic recovery, and the way forward, hopefully. Clearly, what started as a health emergency quickly translated into an economic emergency. The shock waves have been felt across the world. They've been unprecedented, and so has been the policy response. But we are not out of the woods as yet. The number of cases are on the rise again in some parts of the world, and we know the road to recovery will be bumpy. So the question is, where do we stand today globally? What lies ahead of us? And more importantly, who's going to lead us through the recovery at the global level? I'm pleased to have a guest speaker, Mr. Murad Chaudhry, Professor Murad Chaudhry with us today. I'll introduce him in a bit more detail a bit later. But let me just pass on to Mr. Ashwaq Tola, the chair of the OCC and the Economic Advisory Committee of ICAP, for his welcome remarks. Tola sir.
Bismillahirrahmanirrahim. Dr. Murad Chaudhry, my dear friend Shoaib Mehman, our Honorable Chairman of Northern Region Committee, Rafkat Hussain, and my team of OCC, and diligent team of Economic Advisory Committee, and my members, fraternity, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. Again, it's a very good occasion for ICAP to go internationally and invite international speakers to address the fraternity and to give us their insight and knowledge and experience of how the world will move in this pandemic situation. As we all know that the world is getting a bumpy ride, and obviously the second wave is about to due, and in most of the countries they are there. In many of our countries like India and maybe US, the first wave is still on. And in China, the second wave is also subsided. In Pakistan, we have also witnessed quite a few increased cases, but I believe that it will be controlled, and we are doing our level best to control the second wave of this pandemic. However, having said this, we have got a very vulnerable economy ahead of us, and we know, according to the latest estimate of Asian Development Bank, we will be lowest in the region. Our recovery, and if at all we will grow by 2%. And we know the world is again facing great crisis, and we may end up in recession. Recession in most of the countries are there, and I don't know whether we go into depression or not. How we will behave, how commodities will behave, how metal will behave, how our all economy and GDP growth will behave, the business will behave. I know we have got one of the best speakers in the world, Professor Murad Chaudhry. And we will take his insight, his views, and obviously it will be benefiting me and my members a lot. And I hope that this program will be remembered for good. I'm extremely grateful to my UK chapter of Overseas chapter committee that they have arranged this webinar like previously it was done by Oman chapter and UAE chapters. Now Bahrain chapter has also arranged a webinar, and we have got this UAE chapter who is doing it now. And I hope that this stream will continue, and we will be having eminent speakers like Professor Murad Chaudhry. I hope that we will have a follow-up webinar as well. And hopefully we'll get some more insight as the time passes away, and we'll be settled in our COVID situation. With these words, I'm extremely grateful again, and I welcome Professor seminar. It is a very good, important point and a topic. And hopefully, we'll be doing our best today, and we'll be more learned after this webinar. With these words,
Thank you, Tola sir. As always, I think it's worth giving credit to ICAP for taking a lead on setting up this webinars in Pakistan. I think the leadership of ICAP has to be given credit for setting some excellent sessions. I've attended quite a few of them over the last few weeks and months as well. So clearly ICAP is leading from the front in terms of undertaking such important sessions in these testing times for everyone. Now, moving on to Professor Murad Chaudhry, who has an excellent and impressive background as a banker, as an author, as well as an academician as well. His book, Past, Present, and Future Principles of Banking and Finance, is a good guide, is an excellent guide on bank risk management and meeting the challenges of competition, regulation, and also the challenge of the digital age as well. Interestingly, we should have that book available in ICAP libraries fairly soon as well. They are on the way. So we're hoping that people can benefit from his books in Pakistan fairly soon. I've known Murad for a number of years, and we worked together going back many years as well. We've had our difference of opinions on a few things as we work together. Murad, I'm sure, will recollect those. But one thing is for sure, he has always had his pulse on the market. He's appeared very frequently on Bloomberg TV, CNBC, etc., sharing his wisdom. And I am very much looking forward to hearing his views today and engage with him on a number of topics. So with that, Murad, over to you, and then we'll just continue interacting as you go through your thought process. Thank you.
Thank you very much. Thank you very much, Mr. Memon. Pleasure to be here. Assalamu alaikum, everybody, all the listeners out there. And first of all, I also thank Mr. Tola for that very wonderful introduction and his very kind words. It's a privilege to be here, but his very kind words introducing me, I do hope I'm able to live up to them. So thank you again to you and also to you, Mohammed. And yes, indeed, we have had our difference of opinion, but that is the thing about finance, financial markets and banking. There's always more than one right answer to any particular solution, which is why it's very important to debate them at the relevant management committee. I have a banking background, as Mr. Memon just mentioned. So for myself, I would always recommend the bank's asset liability committee to be the forum for debating just this sort of stress event that every country and every company is working its way through now in 2020, which is the COVID-19 stress event. But of course, in other sectors, in other industries, some of which have been hit a lot harder than banking, particularly those involved in any aspect of social interaction, you know, the leisure, the entertainment, the holiday, the travel industries, corporate entities there are working through some significant problems and challenges there. And it's very important for their relevant executive committee to be debating the issues and agreeing a way forward on all the challenges they face. So I've got a few slides to kick off, and I believe I need to share the screen to do that. So if you bear with me 1 second, I will do just that. Just opening them up now, and I shall be able to share them with you very shortly. There we go. I hope everybody can see that. I'm going to go into presentation mode. Okay, I hope that everyone can see and hear me and also see my slides. We're just going to have a short presentation on COVID-19 policy response impact for ourselves, those of us who work in the finance and treasury space in any corporate entity. You'll forgive me, I'm sure, and my apologies in advance for the emphasis within the banking sector. It just reflects my own background and knowledge and experience. But much of what, I'm hoping much of what I'm saying or about to say in the next half an hour or so will be relevant to FDs and CFOs and treasurers in any corporate entity. So first of all, what is it that we're talking about? It's a global pandemic. It was officially described or defined or called a pandemic by the World Health Organization some months ago. And all around the world, the majority of governments' response to this pandemic risk has been what's called lockdown. An unfortunate term, I think, but nevertheless, it's in universal use, and it refers to, of course, basically closing down economic activity that involved social interaction, or if not closing it down, severely restricting it. And that has created a market-wide stress event for all corporates. I mentioned that this has impacted other industries much more than banks. Banks are impacted. In fact, banks ultimately are impacted no matter what industry is, because their customers are in this space. But whether one is in banking or in the more heavily impacted sectors like like entertainment and travel and leisure, it's important to address the problems as soon as possible. And of course, we're now 5 or 6 months into it, and to agree both a tactical and a strategic response to this. From the banking perspective, the important thing to remember is that unlike the last global stress event, which was of course the bank crash of 2008, banks aren't part of the problem this time. So that's a good thing, if you like. That's a 1+ in the current environment, because not being part of the problem, they can, and I think should, be part of the solution. And in fact, if you look at the government and public sector support measures that have been implemented around the world, banks in most countries are the conduit through which governments are able to pass on their support measures. And I'm going to just show you by way of example some of the support measures that have been taken in the UK, in the European Union, and in the US. Here we go. So for example, quite early on, we saw some fairly early response. And to me, my personal opinion, actually quite surprisingly quick response from the regulatory authorities. In the UK, back in March, when they announced the lockdown, they also announced support measures such as payment holidays on loans for both retail and corporate customers. They cut interest rates, base interest rates, from an already very low level of 25 basis points to 10 basis points. Personally speaking, I didn't see what benefit that had for an economy about to enter recession, but other people have a different opinion. They also announced various stimulus packages. Something that the European Union wide has done, including the UK, was for the government, for the public sector, to pay employees' salaries so that their employers, the corporate entities who employed them, didn't make them redundant. We call that in the UK the furlough scheme. In the US, that actually took the form of direct cash transfers. So there was an interesting paradox in the start of the crisis in the US, where household incomes were seen to be going up rather than down, which is the normal observation in a recession or in a crisis event, because of the federal transfers of cash direct to families. But also one thing that happened in the US that prevented a money market freeze, a global money market freeze of the kind we observed in 2008, which impacted all economies virtually, was the US Federal Reserve extending its swap lines. Previously, they had US dollar swap lines, which enabled 5 central banks around the world to obtain to obtain US dollar funding in return for their home currency. And this was lines that were set up with the European Central Bank, the Central Bank of Japan, the UK Bank of England, the Canadian Central Bank, and the Swiss Central Bank. They extended that to 4 other country central banks, including Brazil and India. So extending it from 5 to 9 countries went a long way towards stopping what may well have happened back in March and April, a repetition of 2008, which was a freeze in the foreign exchange and the money markets. It didn't happen, which is why I think the immediate impact wasn't as severe as we saw in 2008. That said, that's from the money markets point of view and corporations obtaining dollars via their banks for dollar-based funding. Of course, we still have the economic impact continuing. So the ultimate play out of this stress event could well be worse than what we observed in 2008 with respect to an economic recession. Just something else on that slide that shows what other countries were doing. We had central regulatory support in the European Union, in Asia, in the Middle East, all taking more or less similar forms. Government support, by that I mean taxpayer support, for corporates in the form of guaranteed loans, for retail consumers in the form of either, say, furlough scheme or direct cash transfers, and also increased purchases of credit risky assets from central banks. All of this, whichever jurisdiction one is looking at, reinforces, in fact, it increases the size of what happened from 2008 onwards, which is the public sector underwriting the private sector. You may be interested to notice that the liquid stock markets around the world, the large stock markets around the world, the recognized indices, whether it's in the US, in Europe, or in East Asia, they didn't see large falls. They saw immediate falls back in March, but they haven't crashed from a stock market or a share price in perspective, as we saw in, say, for example, 1991 in the UK or in 1987 around the world. And my own personal interpretation of that, or reason for that, is the fact that the public sector is now, to all intents and purposes, underwriting the private sector. If you have central banks continually increasing their their bond buying purchase program, their asset purchases. We have very low, zero, or indeed negative interest rates in many currencies. And we have direct government cash support for retail consumers. There's every reason for the private sector part of the economy as represented by share prices to be supported, which is why my explanation of why we haven't had a severe stock market fall. And I've just got a few slides building out a bit more detail of what we saw in the initial response back in March and April this year. I mentioned the US Federal Reserve increasing its asset purchases as well as extending its swap lines. That measure, that step they took in March, the top one at the top of slide 4, I think went a long way to not having a repetition of 2008. So it's not a bank-led crash. This is more a consumer-led crash. And by that, I mean, if you require consumers to stay at home and not go anywhere and stop doing what they do normally day to day, that results in a knock-on effect where all suppliers, corporate entities, suppliers of any product to their ultimate end user, which is consumers and the employees of consumers, say, for example, at large corporates, they end up having a reduced cash flow, which results in them experiencing economic output decrease, which of course results in recession. So this isn't a finance market bank-led recession, it's a government-directed consumer-led recession. And of course it hasn't played out. We are not out the other side of it yet. You've heard in the introductory remarks today about a second wave. And in fact, I agree with the observation that in the US and in India, for example, not related, possibly Brazil as well, we haven't had the first wave over yet. China perhaps ahead of the game because of course it kicked off there earlier, possibly having their second wave finishing. But in Europe and in the Middle East, I would say the second wave is set to come once winter comes along. So we're not over this yet. So the depth of the recession could make 2008 look quite benign. You probably would have guessed by now that I am one of the more pessimistic views when it comes to the global economy in 2021. I will come to my reasoning for that shortly. Just another slide on the ECB measures that were taken. I'm going to leave you to read that at your leisure, and then also at the Bank of England. In the UK, we had, as I mentioned, a lowering of central bank base rates. I personally don't think that has any benefit for the economy, but that's a personal view. But we also had, again, reflecting what happened in what was observed in the European Union as well, the loan payment holidays, the increased bond buying program, and also guarantee of loans. So there was a government guaranteed loan scheme for retail, SME and large corporates to borrow funds from their banks, and the banks should be reasonably willing to lend because the loans were guaranteed ultimately by the government. They weren't 100% loan guaranteed in all cases, but they were 80 to 100%. So in theory, that is central authorities, taxpayer support to assist companies with their cash flows. Now, something that one would observe in past recessions, and I have observed it going back to 1991, generally when there is an economic recession, retail and small corporate borrowers or entities prefer to pay back loans. It's very rare to observe outside of certain sectors, retail and small corporates increasing their leverage, increasing the amount of they borrow when there is either a recession or a perceived forthcoming recession. People generally, in the face of uncertainty, like to pay down loans, whether you're a retail borrower or a small corporate. So actually making guaranteed loans available isn't necessarily the solution, the complete solution that the government might think. So let's just bear that thought in mind as we move on to talk later on about the economic impact. So COVID-19 policy impact was this lockdown response, which resulted in severe impact, negative impact on all kinds of corporate entity cash flows. If you think about it, the extreme example I could think, which is still closed, would be something like in the social and entertainment sector, something like a bar, where there's social distancing, people are meeting there. It's now closed. You've seen revenues going reasonably normally through January, February. Suddenly by April, they've gone to zero. If you're a corporate entity whose cash flows goes from reasonably stable to zero practically overnight, it's quite a severe economic impact with a knock-on effect on your employees and a knock-on effect on the way they spend their cash reserves on goods and services themselves. So the knock-on effect is quite considerable. That's why I said at the start, it has impacted just about all industries. Now, of course, there are a number of industries that have, as there are always in any crisis, benefited. If previously you were a shareholder in a company that made this type of conversation possible, I can present to you without being in your time zone, then you're benefiting from a rise in your share price. If you're a company that makes personal protective equipment or other such product, then you will be benefiting. So of course there are industries that are benefiting from the stress event, but they are outnumbered considerably by those that have had a negative impact. From a bank's perspective, I've written on the fourth point there, supporting the customer franchise. I originally wrote that from the perspective of banks. But as I sit here and think about this, actually, if you're a corporate entity with an eye to surviving the stress, so let's get through this recession, get into the beginning of 2022, we want to still be a viable entity, whatever industry I'm in, then I would have thought that supporting your customers and demonstrating that you're still there for them actually is good strategy anyway. So supporting the customer franchise isn't something that's an imperative for banks only. I would have thought it's an imperative for any corporate entity that has customers, which ultimately is every corporate entity, unless of course you service only the public sector, in which case probably you have a guaranteed buyer. But everyone else in the private sector, I would have thought it's incumbent on them to look at, from a tactical as well as strategic point of view, maintaining support of one's customer franchise. And that's not just existing customers. If I take an example from the bank sector here in the UK, I've heard lots of hard luck stories and bad news stories about banks not being there for both existing and new customers. Again, if I'm a corporate entity, whether I'm a bank or otherwise, it's in my interest to look to support new customers contacting me for my product, because they will remember me once the recession is over. So that's the key driver for me. If someone was to say, what's your takeaway of the current stress event from March, looking forward into New Year, I would say support the customer franchise, whatever it takes, if possible, whilst maintaining balance sheet viability, support the customer franchise. And then if you look at that second to last bullet point, cash is king. In a recession, absolutely, maintaining as much liquidity as possible and minimizing outgoings as much as possible, while maximizing your source of funds, whether it's a credit line, a rollover of an overdraft facility, selling assets that one is able to sell while still maintaining your customer service. I think all of these measures to maximize cash or liquid pool availability is very important, mainly because we don't know how long this will last. There's a lot of uncertainty still, so maintaining as much cash as possible has to be the number one objective, alongside a parallel number one objective of supporting the customer franchise. One other imperative, of course, and that's the last bullet point there, digital working and customer service capability. Some industries and sectors simply can't work digitally. Banks have been able to adapt quite quickly, in my experience, to supporting their customers whilst not talking to them on the phone, or reducing their their call center service, not meeting them in the branches, simply dealing through the internet or through the smartphone. It differs in different jurisdictions, but that's one industry that does lend itself, for most products, not all products, to a digital customer interface and interaction. But of course, there are a large number of sectors where that's just not possible. And so where it is possible, it enables one to continue working through the lockdown, but where it isn't possible, cash is king. And seeing where one can preserve customer franchise and maintain orders whilst maintaining a liquid pool, a reserve pool of cash to meet uncertainties, I think has to be the driver, the number one driver for all industries and all sectors. I just extracted something that I saw on JP Morgan's research a couple of months ago. The first line there, the second bullet point, individuals started to stockpile physical cash. Now that's a response to, that's a US market observation, which I found quite interesting. And I would surmise it has been replicated, or has been mirrored in other jurisdictions. In this sort of environment, small corporates and larger corporates are looking to preserve their liquid cash pool, whether it's in a bank account or not. But at the retail individual level, there has been an effort to increase reserve cash facilities, for example, an overdraft facility, as well as withdraw cash. Interestingly enough, in certain jurisdictions, cash is not acceptable anymore. Not formally, but informally, where you go to a lot of shops at the retail consumer level, and they say it's card payments only or smartphone payments only. In that environment, of course, cash is no good to you. But in a number of other sectors, cash is still important. And I wasn't surprised to see that observation in this research. Just something
Sorry,
I should have
Murad,
put. Yes,
do you
sir.
mind just interjecting over here? Just
By all
going
means,
back
yes,
to
of course.
the,
Yes, of course.
Thank you. I appreciate that. Just going back to the policy response we've seen from the global, sort of the major central banks. A couple of questions there. So one is, what if this crisis prolongs, which by the looks of it, it most likely will. So what other tools do you think they can use? Related to this is then secondly, are we going to see a sort of a period of increased inflation fairly soon with all this liquidity and quantitative easing coming in?
Okay, very good questions. Let me take your first one. What remaining policy response is there? You won't get, so I'm going to give you my personal opinion, as all of this is. I wouldn't have thought you're going to get any official from any central bank to say what I'm about to say, because they always like to say, we've got other tools in the toolbox. The one that frightens me the most, actually frighten is the wrong word. The one that annoys me the most is this reference to negative interest rates, which I don't think actually makes any difference in this environment. The only person that really loves negative interest rates is the government borrowing office, because they can borrow at negative. Who wouldn't like to do that? They will not say to you they don't have anything left in the toolbox, but other than increased purchases of credit risky assets like corporate bonds and increasing the guarantee, which is really a government support rather than central bank support, my personal opinion is they don't have anything other in the toolbox. So if this crisis continues, which personally I think it will into 2021 in most jurisdictions, not necessarily in all of them, you look at South Korea and Sweden, they appear to have done the hard work. And so possibly it might not impact them. But of course, these are trading economies. South Korea and Sweden might not be impacted domestically, but they will be impacted through their trading partners because they're open trading economies, both of them. But if someone says, okay, this crisis goes on into 2021, what else can we do? I don't think it's a monetary policy response because they've got no more interest rates to cut. They may go to negative, like we're hearing the Bank of England might do, but I don't think that will make any difference, not at the retail consumer level. And I can explain why shortly, why I think this is the case. What we're going to see is more government support. So what's probably likely is an extension of cash transfer schemes, an extension of job retention schemes. From the central bank perspective, more purchasing of government bonds, which is basically the government funding its debt itself, money printing, quantitative easing, and also more purchases of corporate loans. But to me, that gets dwarfed if the government is already guaranteeing loans. So that's the policy response I expect to see. I expect to see more of the same when it comes to quantitative easing and asset purchases. But the real genuine impact at the retail consumer level will come from the central authorities as opposed to the central banks. It'll come from extension of cash transfers and extension of response schemes. Your second question was, sorry, forgive me. What was your second question?
Inflation.
Yes, of course. Sorry, it was at the tip of my tongue. It's old age. Sorry, it's old age. Inflation. I knew it was inflation. Okay. If you ask me personally, I think inflation is not a worry, despite all of this low rates and quantitative easing and money printing, because we're not operating in an orthodox corporate finance environment. The Eurozone has not seen any increase in inflation, even though they've had negative interest rates for 6 years. The US Federal Reserve changed its inflation targeting to, rather than 2%, a range 0 to 2%. I think inflation is going to stay low for the foreseeable. And by foreseeable, I wouldn't say it's a problem in the next 2 to 3 years. So I don't think inflation is going to be a problem. If anything, in some economies, deflation might be the problem. Because if we can't stimulate prices and they start dropping, it's an even more serious problem. The real issue is preserving jobs. I think the real issue in any sector, anyone in any corporate entity, in any industry around the world, the real issue is preserving jobs, because at the end of the day, if we are forced to stay at home for long enough and not go out and spend money, let's be honest, literally spend money with all the various people we like to spend money on for goods and services, then we're going to have a severe, long-lasting recession. So I don't think inflation's a problem, because we're not operating in an orthodox environment like we were pre-2008. people would say to me, oh, well, hold on a minute. When rates are very low and there's all this money printing, there's surely got to be pressure on wages and there's surely got to be pressure on prices. Pre-2008, I would have agreed completely. In fact, my economic schooling is Professor Milton Friedman, Chicago school. I'm orthodox free marketeer. But post-2008, with the increasing role of the public sector in the private sector, whether it's very low rates, quantitative easing, bond purchase, government loan guarantees, I think that orthodox economic relationship has temporarily, 12 years now, stopped operating in the normal way. There won't be pressure on wages because people will be worried about their job. So the inflation driver is not there any longer. And the key issue here is job preservation.
Brilliant, thank you.
Okay, shall I press on with the presentation?
Yes, please.
Okay, sure. So if we go back to the market impact, and then I should have had this slide immediately following the the Federal Reserve slide earlier. We've seen here a very significant increase in the size of the US Federal Reserve's balance sheet. And if I were to replicate that graph for all the central banks around the world, the major central banks around the world, the Bank of England, the ECB, the Bank of Japan, we will see exactly the same picture, which again reinforces my, well, worry is a word, but also my question. If we have semi-permanent public sector support of the private sector, what is happening to the free market economy? Is it something that we accept forever? Or is there some point when they will look to unwind it? And whether it's unwinding negative interest rates or zero interest rates or unwinding quantitative easing, I don't see that happening anytime soon. So this picture shouldn't, as it would have done, say, 10 years ago, made me worry what's going to happen with all this public sector support. It's now the question is, okay, what's going to replace it? Unless you're saying we'll just have a permanent public sector backing of the private sector, because I'm wondering what happens when this becomes permanent. Is someone suddenly going to think, well, hold on a minute, there's no real value in this currency anymore because they're just printing it in the way that Zimbabwe did. When Zimbabwe did it, they just got lots of opprobrium. But when large central banks around the world do it, it's called quantitative easing and no one seems to mind. So the issue now is what is it, if anything, is going to replace the current market economic business model? So just another economic point I wanted to make. I just saw this in a recent slide somewhere, I forget exactly, on the internet, obviously somewhere, the IMF's World Economic Outlook from April to June. So they would already have updated it. But let me just show you April's forecast to June. We see here that the IMF in June, which I admit was 3 months ago, let's hope they've changed their mind. Well, I say let's hope they've changed their mind, but an IMF forecast is just a forecast, right? A forecast is always just a forecast. We can either agree with it and act accordingly or have a different opinion and act accordingly. But if I looked at their forecast in June compared to the previous quarter, they were indicating a V-shaped recovery. In fact, a very obvious V-shaped recovery, okay? They revised it downwards, but they were still making the same sort of forecast. With all due respect to the IMF, I have to disagree with this sort of optimism because I don't see what it's based on. If we don't know the extent of a second lockdown impact, if we don't know to what extent in Q1 2021 we will still be required to stay at home, or we can't meet in groups of more than 6. In the UK here it's now 6, or we can't all go to a football match or a cricket match, then I'm wondering where this optimism comes from. And so my personal view is that it would be a U-shaped recovery with a very long bottom of the U, and that recovery upward is going to be slanted at a very low angle. So it's almost like not even a U. It's like a drop down to here, a long bottom where we're scraping along the bottom, and then a very gradual increase. People looked to the UK and saw that in July, the GDP was up 6% month on month. That's because in April, May to June, it was down 20%. But starting from a very low level is not, to me, a signature or a sign, an indication of a V-shaped recovery. If you're saying to me, when do we get back to summer 2019 economic output levels? My personal view is at least not until 2022. Okay, and that's by no means the most pessimistic forecast that I've seen. So I base this pessimism on the fact that there's too much uncertainty at the moment. We don't have an outcome at the end. We don't know how long the governments will continue pursuing lockdown policies, which have the effect of of cutting economic output. Okay, so if you look at the third bullet point, it says there, for stress testing purposes, banks have been working with a V-shaped recovery, but a U-shaped recovery should be assumed. That's my personal view. If you're a corporate entity, not just a bank, in any sector, I would suggest your planning reflects a long drawn-out recession. I personally, again, with all due respect to other economic commentators, can't see why we would see a rapid rebound. The travel sector is still completely, well, not completely, but it's greatly shut down. The leisure and entertainment sector, there's a knock-on effect on the fact that people are working from home more. So all those supplying corporate entities, the suppliers that require office workers to purchase their goods and services, are also suffering. So there's so many sectors impacted, which then knock on other sectors that aren't directly impacted, that I can't see why it would be a quick recovery. And then we've got, as I said, the second wave, localized spikes, and in some countries, as we said at the start, we're not even sure that the first wave is over yet. So that would explain my pessimistic outlook. Just something that I wanted to highlight, not specifically to banks, but it should give us some grounds for optimism. Quite early on, regulatory authorities all around the world, spurred by the Bank for International Settlements, or specifically the Basel Committee for Banking Supervision, put out a press statement. This is April, so it's some months ago now, saying banks are there to support their customers and they should use their balance sheet resources to make loans available and to meet customer deposit withdrawals for all kinds of customers. Why is this an upside, a plus, the one silver lining in the cloud? It's because from the banking sector, at least, we should see support forthcoming to us as retail consumers. We should see support coming from banks who have been guided by their regulatory authorities to use their balance sheet resources to support customers, their balance sheet resources of capital and liquidity. And of course, this has come about because since the last crash, the global financial crash, the bank crash of 2008, new regulatory guidelines had resulted in banks in the last 10 years building up their balance sheet resources to very high levels, historically, relatively speaking, very high levels of capital and liquidity reserves on bank balance sheets around the world. Remember, the Basel Committee is a global guidance setting committee for bank regulators. So around the world, we have seen healthy balance sheets, and so these are now available to be deployed to support customers. So that's worth bearing in mind. That's a silver lining in the cloud, because at least it shows that as retail consumers, there should be no technical reason why banks aren't able to assist customers with loan requests, and also to assist customers looking to draw down cash balances. Something very specifically for banks, the Asset Liability Committee and the balance sheet. I just want to reiterate again, for those of you working in the banking sector, the critical point is preserving the customer franchise. So the role of the Asset Liability Committee, to me, is clear. It should be recommending for board approval what actions to be taken to preserve the balance sheet, but also what resources are available to help customers. It should be maintaining communications with the regulator to inform it of its measures, and of course it should be maintaining communications with the relationship managers. So the role of the Asset Liability Committee is key here on an ongoing basis. Outside of the banking sector, I would still say preserving customer franchise is important, and it's the role of the relevant management committee to address two things: to what extent it wants to support the customer, that in other words, make goods and services available at prices that reflect customer conditions, but also how much balance sheet resource do we have. And that was the point I made at the start for all industry, for all corporate entities, about maximizing the cash pool. ALCO managing the balance sheet, just a slide there about the two-way communications role of the bank's Asset Liability Committee. That's very specific to banks, so I will leave all you bank FDs and CFOs and treasurers to read that at your leisure. And then something that I would suggest, and I was suggesting from March onwards, about having an action plan to address this stress event. An action plan for all corporate entities, not just banks. I know that slide 15 is relevant, is speaking about banks, but what should the corporate entity be doing in the immediate term, in the short term, and in the medium term? And the medium term action plan that we should be drawing up now is not just a strategic view of what we do post the crash, but also lessons learned, how we acted, how we adapted during the stress event, and also how we can benefit. As I said, in all stress events, in all recessions, in all market downturn scenarios, there are opportunities to do other work, to do further work, to benefit from. What opportunities are there amongst our particular customer franchise that we can benefit from? Is it a new service provision? Is it a new type of product? Is it meeting a customer demand in the digital space so we can now interact digitally in a way we didn't before? I mean, speaking personally, I never thought that I would teach a course sitting here in my study. But since March, one would be surprised how many requests I've had from around the world to deliver courses. It could be 90 minutes or it could be all day, which gets a little bit stiff on sitting down. But it could be all day to deliver courses on finance simply from my desktop. So that's, again, an adaptability point. How can we adapt to meet customer demand for goods and services in a way that still preserves some element of revenue generation? And from a bank's perspective, I've summarized some slides. I've summarized some points there from a bank's perspective. But I do think the maximizing position of your cash position, maximizing your liquidity and cash position, is a very important immediate term action, which obviously we're now in September. This would have been something we discussed back in March that all corporate entities should be doing. It's not just preserving cash now and looking to cut costs where possible, but it's also about ensuring reserve cash availability, which would include, for example, increasing overdraft limits or asking for new overdraft limits from other providers, really maximizing your sources of cash for any eventuality. The medium-term points I mentioned just now were also relevant for all corporates, not just the banks. Review the lesson learned and see if there's any opportunities for further business. One other thing, whether one is a bank or not, is about data analytics capability, understanding your customer behavior and the impact on your balance sheet. Customer behavior. People always talk about the tech companies, the Amazons, the Googles of this world, really understanding customer behavior because of the way their algorithms interpret and understand and can forecast customer behavior through their past transactions. And not just transactions, the past products they looked at on the internet or on the smartphone. All corporate entities should be looking to establish some element of data analytics that enables them to have fingertip understanding of their customers' behavior. That's specifically for bank finance directors and treasurers, so I'm going to leave that to you for you to read at your leisure. Okay, good, excellent. So we conclude with, we should always remember the current stress event has highlighted or reiterated the fact that stress events always occur with little prior warning and they don't play out like the past crash. So the next stress event will look different and we won't get too much early warning of it. The current crisis has had severe impact around the world on economies, and we're not over it yet. So we're still going to have some deep and severe recession. From a corporate point of view, the objective, I would have thought, would have been to support the customer franchise with as much resource as we have, but also look to preserve our own balance sheets and take away some viability action points for the medium term. The points in red, I think the second one in red about data analytics I already mentioned, and then the third one I already mentioned about, are there opportunities for us? And we should be looking to whether it's diversify or indeed to the opposite of diversify. Should we look to concentrate on core products? Whichever we think is the opportunity to benefit from downturn, or at least preserve some element of customer franchise or increase it, I think has got to be the strategy discussion that every corporate entity is entering into since the start of this stress event. Okay, fantastic. I believe that is the conclusion. There's a couple of references there for everyone. I'm going to stop sharing and hand back to my host. But thank you very much.
Thank you, Murad. That's very insightful. Thank you. Fascinating points. Few things here now. So we already touched on the responses we've seen from the central banks, etc., and so on. Now, one of the points we've talked about is, or we touched on briefly, do you expect a negative feedback loop here with continued uncertainty or unemployment impacting the consumer behavior as well? And hence, we would probably have a much more prolonged recession or a difficult road to recovery.
My personal opinion is yes, because in an environment of uncertainty, for example, our own individual jobs, or at what point we can fully go back to normal and not worry about the continuing instructions from government. In an era of continuing uncertainty, people do less. They, even with government support is being wound down here in the UK. There are calls for it to extend it. It's in Germany, they extended it into next year, but of course, and in France as well. But of course, to give an example, but of course, in any country, it's not permanent. I wouldn't expect, I mean, no one would expect permanent payments and cash transfers. So in this environment of uncertainty, people simply batten down the hatches. They close the shutters. They stop interacting for goods and services in the way they did, because they're worried about their own personal position, their own corporate viability, their employer's viability, and what's happening with the future. So this has, it's a negative feedback loop, to use your expression. It has a knock-on effect on every single supplier that retail consumer would have previously interacted with, whether it's to do with leisure or travel or entertainment or simply buying a new car. So while I have seen here in the UK businesses like house purchases and car purchases still being undertaken, the volumes are considerably less. No surprise there. The relevant question in your context would be, okay, do I see a pickup in next summer? I would expect to see a pickup, but not to last summer's levels, which is why I expect the recession to be much longer lasting and deeper than you might have heard in some other quarters. I'm naturally an optimistic person, actually. It's only because I don't see the end result. I don't see the light at the end of the tunnel. It doesn't help when you don't know what's going to be calling an end to it. Do we have to wait for a vaccine, or do we wait till they just say the lockdown has been eased and you can now meet in groups of greater than 30, or we can now have paying customers going to watch a sports event? Or is it something else? Is it something like, until we get a fully functioning vaccine that we know has been tested and proved, we can't go tunnel? And by the way, despite what certain presidential candidates might be saying, I would suggest that's a few years away. Vaccines don't come quickly to the market. They're complex processes and complex approval processes, and they take time.
Well, I'll come back on that point on the presidential elections towards the end. do expect that question from me. There's an interesting one here. Again, we've received another question from one of the delegates here, and I think you touched on this previously as well. Particularly on the equity markets or in terms of asset pricing in general, with public sector in a way underwriting the private sector. Should we say that the asset pricing or the pricing is mispriced? Let's put it that way. And how do we expect this situation to resolve? I mean, personally, I have a view in terms of the equity markets. There hasn't been much of a change in the fundamentals. Either it is because of the surplus liquidity in the system, or we are seeing some crazy levels there in terms of the global equity indices. So clearly there is certainly there is a problem there in terms of how this is all panning out.
Well, yes. Let's take your last point first this time. Why is it that stock market indices are not significantly lower? We haven't had a stock market crash. We've had some volatility back in March here in the UK. We had we've had the FTSE 100 experiencing volatility, some Brexit-related volatility, but we haven't really had a stock market crash. But your question about fundamentals, unless I'm a company that makes personal protective equipment, or I'm a company that, if I'm a company that is impacted either directly, like for example an airline, or indirectly, like an oil company, why is it that I would still be confident that the fundamentals are good? Because I could see anything from a 5 to 30% reduction in my revenues for the next 4 or 5 years. I could see sustained drop in revenue levels because more and more people just stay at home, because they want to or because they're told to. So I couldn't explain, if I was just a straight orthodox corporate finance, project appraisal analyst, and someone said, value this company previously at this value, this share price, and now we've had the lockdown, why is it that this share price hasn't tanked, unless very specific ones that have been impacted? And the only thing I can think of is this public sector underwriting of the private sector. Borrowing rates are very low. Their interest rates are so low as to be negligible, which is why, by the way, quick aside, if base rates are at 25 basis points, you're not going to stimulate any extra borrowing by dropping it to 10 basis points like we've done here in sterling. It was already cheap at 25. To be honest, it was already cheap at 100 when it was 75 basis points back in 2018. So when they rose it in 2018, it's already cheap. You don't stimulate additional borrowing. I'm either going to borrow money at 75 basis points or I won't at all. It's not the base rate that's impacting my loan decision. It's my own uncertainty whether I can repay the loan. So if borrowing rates are already cheap, so I can fund borrowing to invest in other higher yielding assets, that's a type of public sector underwriting. It's a type, isn't it? Because borrowing rates are perpetually low. The other type of underwriting is QE, which enables the government to basically bankroll whatever spending scheme it wants to, even before it started directly giving cash transfers to consumers, as we've seen in the US and in the European Union. So either directly or indirectly through the job scheme or directly to retailers' bank accounts. So the only explanation I can give that we haven't had the stock market crash in the way we've had economic output implosion, GDP output downturn, is because investors in equities see continuing public sector support and virtually perpetually low interest rates. That's all I can think. I can't see why that confidence has been maintained. Again, it's not to do with just an optimistic or a pessimistic outlook. I've got to look for why 5 years from now, my corporate entity that I hold shares in would be seeing an increased level of revenue when I don't know how long the lockdown will last. That's my analysis. Other people will have a different opinion, of course.
Well, that's very interesting, I guess. In a way, there's a bit of a yield chase going on as well. I think.
Yes, of course. Absolutely. Now, let's not forget there are lots. There are lots, not me personally, and I don't know about you, but there are lots of cash-rich individuals in the world. There are lots of cash-rich corporate entities in the world. What are they doing with their cash? If you're in the Eurozone, you're not going to be holding government bonds. You have to pay them for the privilege. The 10-year German government bond pays you a negative yield. In the UK, the 5-year gilt now pays -8 basis points. If I'm a large cash-rich corporate, or just a high net worth individual, or just someone with some surplus cash. And let's not forget, there are large numbers of those in the world. There is lots of surplus cash holding entities in the world. What are they going to be doing? They will be looking for investment opportunities beyond the bank account and the negative yielding bond. And so that also underpins the stock market, because at least with stocks, I have an opportunity of capital gain increase, with equities, capital gain increase, and the opportunity for dividend. So it's a paradoxical event whereby I support the stock market by having negative or low interest rates, such that people either borrow money cheaply or they're already cash rich, invest in equities, because debt doesn't pay anything unless I hold very low rated debt beyond sub-investment grade, which some people will have the appetite for and other investors won't. So it's a paradoxical situation whereby very low rates perpetuate stock market rises, but the fundamentals aren't necessarily there. Okay, so if you were to ask me, okay, Moran, I'm going to make you, I tell you what, there's a family office. They've heard of you. They want to give you a job as their chief investment strategist, right? They've got 500 million of surplus cash. Or I'll tell you what, how about 10 billion of surplus cash? What are you going to do with it? I have to admit, I would be looking at equities and at sub-investment grade rated bonds, because I'm not delivering value to my shareholder if I hold negative yielding assets. I'm not delivering value to my client. So that's what perpetuates a rise in one market that is disconnected from fundamentals for many corporates, and a drop in the other market, the rates market and the debt market.
Yeah, noted. Thank you. Another question, and I think we'll touch briefly on trade wars as well. But one thing which I think about is who's going to lead us through this, through the recovery. In the past, perhaps what we've seen, US probably being at the forefront, and they're not necessarily in the best shape right now. One has to accept that. So despite whatever spin, as you said, you want to put on it, but it's not looking good there. And then you got China, perhaps, who helped in the last financial crisis with significant investment they were undertaking at that point. So who do you think, in your view, would be leading us through towards the recovery? And what about the trade war between the US and the Chinese, perhaps, potentially? Where do you see this heading?
Yes, very good. Thank you for pointing that out, because these are good. These are not other reasons to add to anybody's worry. Unlike 2008, we didn't have we didn't have the geopolitical stresses that we observe today. I think it's fairly common view for anyone to say that outside of his own personal support base, everyone else in the world would prefer that Donald Trump doesn't win the election in November. I mean, interestingly enough, there might be one or two people around the world, Russia, what have you, that might prefer a win for him, but that wouldn't help them economically either. So that's a paradoxical situation there. You know, countries that depend on commodity prices like crude oil, for example, Russia, Venezuela, you know, countries that aren't necessarily political friends of the US, let alone allies, would benefit from a healthy economy because the oil prices are higher. So we didn't have the geopolitical stresses that we do now, and I don't see any kind of, as you say, leadership coming out of US in response to this if the current administration is re-elected. And the connected point, a very closely connected point about the US-China trade war issue, that's more likely to have a more negotiated settlement if there is a new administration in place than the current one. That one intrigues me, I must admit, because both sides are very symbiotically connected. I don't know how you can pick a war of any kind, trade or otherwise, with someone who holds a third of your debt, you know, but that's the way it goes. And we do need to see more negotiation and face-to-face conversation to address geopolitical issues than simply, the type of arguments we've seen so far. So I don't hold out hope for any optimism on that front if the current regime is re-elected. The current administration, did I say regime? I meant administration. The current administration is re-elected. Regime, you usually use that expression for dictatorships, don't you? So that unfortunately is another worry for us. But of course, at least that one uncertainty is, at least we can plan for it. Once we get to the other side of the 8th of November, or what I think is the 8th, 7th or 8th of November, once you get to the other side of that, at least we can plan for it. Whoever wins, we can plan for it. We might maybe look to do more of the cash preservation, cut costs, look to benefit from opportunities amongst our customers or new customers if the current administration is re-elected, or we might look to be a bit more bold in our investment and our customer initiatives if there is a changed administration, because I can see more negotiation, I can see more conversation rather than the type of arguments we've seen so far. But it still wouldn't be solved. It still wouldn't be solved quickly. It would just result in some lessening of tension. But that's a good thing for the economy anyway, for the global economy anyway.
Okay, thank you. It will be interesting for the next few months on that front. Another question, and I think it links to the points we already touched on, but future of globalization. And I guess perhaps we've seen a lot more protectionism coming in the last few months. Obviously, I guess the governments now have a bigger stake now, or have got a bigger reach in terms of the influence they carry because of the importance given to the health sector initiatives and generally around restrictive measures they have been putting in. So how do you see this now in terms of protectionism? Do you think this would probably be seeing the beginning of the end of globalization, or this is just a temporary blip and we'll just go back to the global supply chains and a global customer base and so on?
I'm personally pleased to be able to say that this is one thing I'm not so pessimistic on, but then it depends one's individual view of one's opinion of globalization. Not everyone is a fan of it. I think in terms of the ability to lift at the average level incomes and quality of life for people around the world, globalization has been a good thing. That's a personal view. I know that it has people, there are a number of detractors of that, and I respect that. I think at the net payoff of globalization has been generally positive for the average consumer around the world. The answer to the question, what do we see? I don't see it as being halted. I see it as being slowed down considerably. Protectionism is on the rise. Again, a change in administration in the US would see a change in that debate about protectionism. I would see, I imagine the World Trading Organization would have a bit more clout and be able to act as a mediator and arbitrator in trade disputes in a more effective way under a changed administration in the US. That's just a personal view. But I do think globalization has been slowed down considerably because of the pandemic reason, as opposed to a geopolitical reason, in that we have lockdowns, we have less travel, we have less cross-border business being undertaken. I don't think that's permanent. I think if we fast forward 20, 30, 50 years, assuming we're all still able to conduct commerce on reasonably civilized terms, I would see that the needs of the global populace will be what they always have been. People around the world, if you exclude the political classes and those in power in various administrations around the world, are pretty much the same. Consumers around the world want the same thing. They want a stable environment in which to conduct their life and work. They want a nice school to send their kids to. They like consumer comforts at home, and they like to be able to have food on the table and a reasonably benign outlook for their future prospective income. People are the same around the world. It doesn't matter whether you're in the northern hemisphere, the southern hemisphere, you're in the east, you're in the west, you're in Israel, you're in the Gaza Strip. The average person around the world wants the same thing for them and their families. And globalization, I don't want to ignore it because it is significant. If you put aside climate impacts, the widening of income disparity, which has been a negative of globalization around the world, if you put that aside, they are significant. But if we put that aside and look at the net impact on the average consumer around the world, globalization assists that. Having a global supply chain enables, and I like using this example because it's from one of my books actually, enables me to go to Dhaka in Bangladesh and see a rickshaw puller using a mobile phone. That's globalization, and that's structured finance and international banking in action. It costs a lot of money to implement a mobile phone network. All right. It costs a lot of money to make a mobile phone affordable. That sounds paradoxical, but affordable to someone who earns the average of $1 a day, a rickshaw puller in Dhaka. Okay. So, or on the Indian subcontinent. I imagine the wages are fairly uniform throughout. So that is globalization in action. That's a good thing. It's a quality of life. So if you fast forward beyond the pandemic, beyond, China-US trade war, I can't see how it would ever come to blows, because if they're owning a third of the treasury market, I don't see how that's possible. Both sides would climb down. But if you fast forward and we get beyond that, we'd be back in the globalization driver. All the things that drove it in the first place, global supply chains, making commerce easier, making products easier for the wider range of consumers, will still be here. So that's my long-term forecast on it. I don't think it's halted.
Yeah, I agree with you. I think there's an interesting comment again. One of the delegates there saying deglobalization will probably have inflationary consequences as well. And I think you and I would both agree with that as well.
Ultimately, it will, yes. If we get back to a stable economic environment of some sort and easing of tensions, the geopolitical tensions, then of course higher commerce, higher trade volumes results in higher corporate values, which results in higher prices, which results in higher wages, which results in inflation. So, but to me, that's a long-term view. But if interest rates stay at zero, then we might not see that. I know the orthodox monetary policy response is interest rates go up to fight higher inflation, but I don't see them unwinding that for some time yet. So that would be my 10-year view.
More of a local question. Like I said, both of us are sitting in the UK. We've seen what a mess we've made out of Brexit. But how do you see this? What do you see as the future of the UK and Europe?
Again, I see. If you give me the 10-year view, if I give you the 10 to 20-year view, I think the UK will be in a relationship with the EU where it's trading normally and both sides are benefiting. I think the next 1 to 5 years is the stress period, is the volatile period, the uncertain period. But if you ask me for the 10 to 20-year view, it's in both sides' interest to carry on doing what they're doing now, which is to trade with each other on as open a basis as possible. Both sides benefit. It's a win-win, absolutely, without a doubt. The issues are in the next now, when we leave the EU, when the UK leaves the EU at the end of December, and in the next, let's say, 1, 2, 3, 4, 5 years, while the machinations of continuing commerce are ironed out. If you ask me for a long-term view, then I would be reasonably relaxed, because again, at the end of the day, I made my my takeaway point from today, which is actually people are the same the world over. They really are. It doesn't matter what language you're speaking, what country you're living in, what currency you're trading. Ultimately, people want the same things. And I think money does talk for every culture, ultimately, to a greater or lesser extent. But if you have the UK as one entity and the European Union as another entity, they're both going to benefit if they continue doing what they have been doing up to now, which is trade with each other, which is why my 10-year view is quite optimistic. It's my 0 to 5-year view that is pessimistic, while we get, the likes of Boris Johnson deciding what he wants to do, the likes of the trade agreement being sorted out, and then seeing what that happens in practice. But if I was to fast forward a long time, 10 years or beyond, they would have sorted all that out. They have to. It's in everyone's interests.
Yeah, it's in everyone's interest. I agree with that. Another question. It's climate change. We in this part of the world talk a fair bit about it, and clearly, I think again, the governments in the West and central banks in particular are taking a view on financing green as well as green financing. What's your view on this? I mean, is this going to reshape how globally the world operates, or in 10, 20 years' time? Is this a threat we have to take seriously?
If you ask for my personal opinion, I think it is a threat we have to take seriously. I don't know. Again, it's my interpretation of all the information I read around me, but simply observing what's happening around the world, I can't see how you would conclude that human activity isn't damaging the climate. That's my conclusion. However, for it to become real and impact economic outputs globally, every economy in the world has got to recognize it and do its bit about carbon emissions. What I find interesting is that when you get individual countries saying we have a target to reduce carbon emissions or to get net zero carbon emissions by 2050, I mean, at the end of the day, it's the whole world. And an individual country doing that won't make any difference to global climate change. And so I can see why this is another one of those things where it requires everyone to realize they're all on the same team. I can see why an individual country might think, well, if I modify my economic activity to cut carbon emissions or to have net zero emissions or to save the climate, but the country next door or a country with more than 1 billion people, like China or India, isn't doing the same, then the climate change issue is still not going to be impacted. And here I am impacting my own economic output. So this is one of those things that requires everyone to realize that we all live on the same planet. And if we take a 50-year and 100-year view, we should all look to do the same to combat climate change. Unfortunately, we haven't got that level of dialogue at the moment. Different countries have different views on this. And again, I mentioned my point about everyone in the world being the same over. Everybody wants, well, not everybody, but just about everybody wants a smartphone, a refrigerator, a car, okay, whether it's electric. I mean, electric driven cars are great for CO2 emissions, but they still have to be disposed of. I've still got components that need to be disposed of in some way if they can't be recycled, which means more landfill. So everybody wants the consumer goods that we're surrounded by, whether it's laptops or phones or cars or fridges or TV sets. That all contributes to impact on the environment, whether it's a landfill or carbon emissions or disposing. And if we don't all do the same, we're going to be impacted differently with a negative impact on our economic output. So I can see why an individual country might have less desire to address that than others, because they don't want to suffer the economic impact of taking this point seriously compared to other countries.
Okay. Well, thank you. It's, I guess it's something to watch this space personally, I believe. There's a lot to happen on that front, but perhaps it's been put on the back burner because of the pandemic. So,
well, yes, it has. Absolutely. Have you noticed how single-use plastic has gone out the window? Right. I mean, a year ago, I couldn't get a straw in a restaurant, right, to drink from. Not that I use straws personally, but now everyone's using single-use plastic all over for PPE. Yeah. You go to a restaurant, they say we're not recycling this; it all goes in the bin. So that's been put on the back burner, and that needs to be addressed. I think. Here in the UK, we've got our regulatory authority. You'll know this, Mohammed, because the PRA, the regulatory authority in the UK, requires banks to address climate change in their capital adequacy assessments. Exactly. Personally, I think, well, okay, fine, we'll do it because you're asking us to do it and we'll take it seriously. But I'm not seeing that management information impact, the board level value add from doing this in the stress test. because it's such a big issue. It impacts, and everyone's got to be addressing it. Me as an individual, it's one of those things. It's a genuine team effort. If I recycle, but my neighbor isn't, I'm not benefiting the economy in any way.
Sure.
So,
good stuff. We've got 5 more minutes, so let me just ask you a few other questions.
sure,
quickly.
by all means.
So interest rate outlook, we talked about it. You don't see interest rate increasing anytime soon, but probably, you've argued your case for not having a negative interest rate. But would that be fair for you to say that, or would you agree that you're not expecting to see interest rates going up anytime soon?
Yes, absolutely. Yeah. If we say anytime soon is between now and say the end of 2021, or possibly even the summer of 2022, I would say no. I would like to, because paradoxically, I think it would benefit the economy, but that's a separate conversation. I don't think they're going up because 2 reasons. Central banks are convinced that this is what is needed to restore economic output levels, to restore the economy. So they won't anyway, without real obvious signs of economic overheating, which is we're not going to see any time. And secondly, actually, this is a very difficult path to track back from once you've entered into it. Once you drop rates to 0, 10 basis points, or minus 50 like they are in the Eurozone, or 0 to 25 like they are in dollars, once you go down there, we'll leave the Federal Reserve. Possibly they might find it easier to do because they have some history of this, because they were raising rates before 2019. Once you go down that route, it's very hard to unwind from it, as we've observed. People think, well, they're raising rates, that's a bad thing. They don't want to affect the stock market. They don't want to see stock market fall. They seem to see it as somehow negative as raising rates, even though paradoxically, again, it's a sign of confidence in the economy. I raise rates because it's overheating, so you should be happy that I'm raising rates. Of course, if you are borrowing money at a floating interest rate, you won't be happy. But really, if you can't afford paying a loan service when base rates are 10 basis points and they go up to 50, then I would suggest your fundamentals are in a problem anyway, because cash-wise, that's not a material increase. So I can't see them rising because they don't think they should rise, but also because it's very difficult to track back from that path. I really don't know how the ECB will unwind from minus 50 basis points at its base rates. When I can see them thinking it needs to go to minus 100. We'll get to, absolutely. Well, it went from minus 20 to minus 40 and then minus 50. And I'm thinking, well, hold on a minute. We got COVID, we got recession. I'll tell you what, let's move it to minus 100. It hasn't worked so far, but if we keep increasing it, it might work. How do you unwind that policy? Do you risk a real negative reaction because you suddenly think, well, it's been minus 50, but don't worry, I'm moving it to 0 now. 0%. In any other environment pre-2008, if I'd said to you the interest rate is 0%, you would have done a handstand down the end of the road. You walked on your hands, you're jumping for joy because you're so happy about borrowing at 0. So I think they're going to find it very difficult to unwind, which is why I don't see rates going up at any time.
Excellent. Let's just move to the FX markets. Again, it's anybody's guess, I guess you would say that as well. But
yes.
You see dollar.
Forecasting FX rates is a mug's game. I always like to say, if I do make a forecast on FX, I always tell you it's good for only 24 hours. No, I don't. Interestingly enough, I've seen this just in sterling, just in 2 weeks. Sterling has been quite volatile against dollar, and if you ask my outlook on US dollar, it has been weakening recently, hasn't it? I mean, I know it's strengthening against sterling just recently. The dollar is a peculiar one because it's the world's reserve currency. And at the moment, US dollar interest rates are virtually 0. The US dollar yield curve, the treasury yield curve, is very flat. So dollar appreciation, I don't see coming from anywhere. So if you were to ask me for a year-end forecast for dollars, I'd say actually it's probably going to be around here against euros and yen and other major currencies. That said, because it's the clearing currency, dollar benefits from other currency weakness. So if, for example, I can see dollar appreciating against sterling because we're gonna leave the EU without a trade deal, it would appear. I mean, here we are in September. I don't know, I could be wrong, but it looks like we're going to leave just without a trade deal. So that's going to be bad for sterling. So dollar would appreciate due to other currencies' weakness, but I can't see any grounds for it to strengthen in per se, because there's there's the ongoing recession issue, COVID-19 policy response in the US. They seem to have done a Brazilian-style response to the coronavirus crisis, as opposed to, say, what South Korea or the UK did. Not that I'm saying the UK response is any kind of benchmark. So I can see continuing weakness in dollars unless there's a specific currency weakness. What would the change of administration mean for dollars? If you ask me personally, I think it's an upside thing for dollars. So if we get a change in administration in the US, I would say that's a reason for dollars to appreciate.
Good. And then two more questions. We'll call it a day then. The new normal. Once we're out of this, how do you see the new normal to be? And I guess linked to this is how big technology's influence would be on this new normal.
Well, I'll take the second question first, actually, because I think the technology influence will be big because it enables the new normal. Technology is enabling everyone to live their lives without, well, I was about to say without leaving the house, but without getting out of bed. I can order everything from my smartphone. Well, not everything, but a lot. I can conduct commerce without having to interact with humans. So technology is contributing a lot to the new normal, COVID or no COVID. The new normal to me as an economic model, I'm actually concerned about, because at the moment, I don't see any unwinding of public sector support, low rates, continuing quantitative easing, continuing asset purchases by central banks. So what is the new normal other than the public sector basically underwriting the private sector and governments borrowing ever more amounts to enable this to happen? Which, by the way, brings me, I think, to a nice last point, negative rates. Why do governments like negative interest rates? Because they can borrow without having to pay back the full amount. If I'm borrowing and you're lending to me at a negative interest rate, I'm going to love it. So actually, this is the expression I've been using. I don't say this publicly, but we're amongst friends here. I reckon central banks, inadvertently or not, they are doing their government's dirty work for them, because they are enabling them to borrow ever larger amounts of public sector borrowing without a real cost to them. There's no real economic cost if it's a negative. I borrow £100 today, and 10 years time, I pay you back 90. What's there not to like? The borrowing sector, the exchequer, loves a negative interest rate regime. So my question for the new normal to me is the public sector, the new normal is very low rates and public sector underwriting of the private sector. At some point, people will look at the level of public sector debt and say, well, hold on a minute, where's this coming from? But that's not happening for the next 3, 4, 5, 10 years. And because governments that are elected every 4 or 5 years are always looking to the next re-election, they only have a 4 or 5 year view. They don't have a 10, 20 or 50 year view. You can borrow UK gilts. The UK gilt market goes out to 50, 60 years. You can, if you wish, you can buy a 50-year gilt, okay, a 50-year bond. And lots of developed economy governments, developed country governments have long-dated bonds. 10 years is short compared to 50. They have long-dated bonds, 20-year, 30-year, 50-year, 60-year bonds. Try, how shall I put this? Which government, which democratically elected government in a developed economy in the world will have a concern about repaying a 60-year loan that they took out today? They're looking at the next re-election date. They're looking at 4 or 5 years. They're looking at their own political careers and how that's going to play out. Are they concerned about refinancing the 60-year bond? They're going to love it even more if they can borrow for 60 years at a negative rate. Now, that doesn't happen yet, but I can borrow in the German government 10 years at a negative rate. In the UK can now borrow 5 years at a negative rate. So the new normal is the public sector at some point, people wondering what is the new normal, because all I see is a public sector underwriting the private sector. But for the time being, that's what I see. Low rates, more digitization across different industrial sectors, and the public sector burden, taxpayer burden being increased.
Yeah, somebody has to pay for all of this.
Yes, absolutely.
Money,
and exactly right. And I'm just wondering who it is. I'm wondering who it is.
Last question then. We'll bring this to an end after this. So who do you see winning the US elections this time?
Well, I mean, the polls all point to Joseph Biden being slightly ahead. It's only about 6 or 7 states that it actually makes any difference. He's got to win all 6 or 7 of those. And when I looked at the last polls in The Economist magazine just this Saturday, they were within a percentage point of each other. So it's very tight. It's going to get quite emotional over there. Thankfully, not for me, because I'm not a US citizen. If you ask for my personal prediction, I think it's going to be Biden, but it's going to be very close. But I wouldn't be surprised if at the last minute there was some upsurge for Trump. But my personal prediction is it will be Biden.
It'll be interesting for the next few months. Well,
yes,
with
indeed.
that, thank you, Murat.
It's my pleasure. Thank you.
The conversations we've had, it has been fascinating. It's been very interesting to hear from you as well. I'll just pass it on to Mr. Rafaq Hussain for his final words, and then we'll bring this webinar to an end.
Thank you, Mohammed. My pleasure. Thank you.
Thank you.
Thank you, Shoaib. Bismillahirrahmanirrahim. Distinguished Speaker, Professor Murad Chaudhry, Chairman Overseas Coordination Committee, Chairman UK Chapter ICAP, worthy members, ladies and gentlemen, Assalamu alaikum and very good evening. On behalf of the Institute, I would like to thank our esteemed speaker, Mr. Murad Chaudhry, for sharing valuable insights covering impact of COVID-19 on global economy and how countries around the world have responded to these impacts by introducing policies and different approaches. Mr. Chaudhry presented different aspects, including economic policy response across different countries. I would also like to appreciate Mr. Shoaib, Chairman UK chapter, for highlighting some important areas and raised some extremely important questions to make the most out of the webinar based on experience and knowledge of Mr. Chaudhry. I would like to highlight that stress events will always occur with little warning and will not play out like past, as in the case of pandemic versus financial crisis 2007-8. So governments around the globe have to keep responding positively and proactively to support the economy and the society as a whole, especially when experts are talking about second wave of virus, increase in number of new cases, lockdowns, and U-shaped recovery. With this, once again, I appreciate Mr. Murad for his wonderful presentation. I congratulate Chairman Overseas Coordination Committee, Mr. Ishfaq Tola, Chairman UK Chapter, and organizing team for holding this important webinar. And I'm grateful to all the participants who have attended this webinar and shared some important questions related to the presentation. I thank you all for joining and hope to see you all again with a new webinar. Thank you very much.
My pleasure. Thanks very much, Mr. Hussain. I appreciate it. Thank you, everybody. Have a good day.
Thank you,
Take
Murad.
care.
And thank you to the wonderful team at ICAP as well. Once
yes,
again,
indeed. Thank you, ICAP.
Thank you to
Bye-bye.
the delegates who attended. Take care. Thank you.